Assalamu alaikum and good morning. Welcome to Keypoint's webinar on tax and Zakat updates. This is the third webinar in a series of webinars held in this past week. In the first one, we covered the amnesty procedures that were announced by the GAZT way back in March. In the second one, we covered VAT issues and also assessed the impact in Saudi Arabia by the announcement made by the government a couple of days back that they are intending to increase the standard rate of VAT from 5% to 15% with effect from the 1st of July. If any of you have not had an opportunity to view those webinars, please do let us know and we will make them available to you. Hi, I'm Raman Ori, Senior Tax Manager, providing a range of advisory and compliance services, both local and international. With me today is my colleague Dinesh Ravi, Tax Manager within the team. And we also have two panelists who will be taking questions. Mubin Kadir, Senior Director at Keypoint, and Adil Fauzi, another one of our tax managers. If you have any questions, please feel free to ask by entering them in the Q&A function at the bottom of the screen. We will try and answer as many questions as we possibly can. So today we are going to be talking about the updates with regards to Zakat, namely the new Zakat regulations, which came into effect from 2019, some corporate tax updates, some withholding tax updates, including the recently concluded treaty between KSA and the UAE, and finally, some international tax updates. And with that, I will hand it to Dinesh to talk to you about the Zakat updates.
Good morning, all. Thank you, Roman, and thank you, everyone, for attending our today's webinar. Before we start talking about the new Zakat regulation and updates, I just want to give you a brief introduction and background of Zakat. As most of you are aware, that Zakat is a religious levy imposed on the Saudi shareholder of a company at a rate of 2.5%. Historically, in the past, the concept of Zakat is very simple. Any liability that remains with the company for more than one full Hijri year will be subjected to Zakat, or any liability that used to finance the fixed asset of a company should be added to the Zakat base. On the other side, from deduction, any investment that company is making in the fixed asset or any investment that company is making in other subsidiaries in KSA or outside KSA can be deducted as a deduction in the Zakat base. So on 14th of March 2019, the GAZT has published new Zakat regulation under Ministerial Resolution 2216. So we are going to see how this new Zakat regulation have impacts on the old and what are the changes that's there in the new Zakat regulation compared to the old practices that businesses has been following up, and what are the key points that businesses needs to consider while determining the Zakat base in terms of addition and deduction of the items in your Zakat return. Okay. This new Zakat regulation, which came effect in 14th of March, it's applicable for the clients where the commencement of a business from 1st or after 1st of January 2019. The Zakat payer who follows the Gregorian year, that is 365 days, are subject to the Zakat at a rate of 2.578% on Zakat base, excluding the adjusted profit, adjusted net profit. And adjusted net profit is calculated always on 2.5%. So the total Zakat due will be Zakat base, that is 2.57%, excluding the adjusted profit, plus 2.5% of adjusted profit. That will give you a total Zakat base. And then, as most of you are aware, that Zakat base is always either higher of adjusted profit or higher of Zakat base, where in case your Zakat base is lower than the adjusted profit, then net adjusted profit will be determined as to calculate the Zakat liability for the businesses. And the important updates that came in the new Zakat regulation is consolidated Zakat filing is no more mandatory for the Zakat groups. Before we move on to the addition and deduction of the items in the zakat base, the zakat base for the non-financial activities is basically classified into four categories or four elements. That's indirect source of funds, external source of fund, adjusted net profit, deductible assets. In internal source of funds, basically you'll add your share capital, retained earnings, statutory resource, and provision. If you have any dividend distributed during the year, that can be reduced from your opening retained earnings, and net of retained earnings will be added to the zakat base. Same in case of provision, whatever the beginning balance that you have, that can be deducted from the utilization of provision, and remaining net should be added to the zakat base. When it comes to external source of funds includes loans due to related party, accrued expenses, advances from customer, trade payable, or any payable that remains with the company for more than one full injury year, that should be added to the zakat base. And then the adjusted net profit, and then deductible assets such as fixed assets or intangible assets, spare parts not held for sale. Here, the spare parts means the spare parts used in the fixed asset, and as well as the long-term investment and capital work in progress. In the past few months, GAZT has released various zakat guidelines for targeting the specific industries. Here you can see the lot of specific industries where GAZT has published the guidelines. Even though there is a lot of guidelines has been published, the calculation of zakat remains more similar and same for all the sector. Each of these slides more talks about the nature of business that comes under the specific sectors. And as most of you are aware, like there is also a separate regulation and rules has been introduced by GAZT for the calculation of financing activities under Ministerial Resolution 225. This calculation of zakat for financing activities like bank under the financial company, that will be a separate calculation and separate regulation apart from the one that general business is following up. Okay, other key measures that business needs to be considered and aware before preparing your zakat return or before calculating your zakat. The key, I'm going to go through all the key points that has been covered in the new regulation. First, we can see the addition of long-term loans and external source of funds. As I discussed in my previous slides, what are all the external source of funds? So in this case, the addition of long-term loans and external source of funds in the zakat is restricted only up to the level of total deduction. So what it says, example, if a business has a long-term loan and external source of funds, such as like due to related party, trade payable, or any other payable amounting to 5 million, and you have a total deduction in your zakat return of 4 million. So in that case, your addition of external source of funds will be restricted up to the level of deduction that you're claiming in your zakat return. In my example, I have mentioned 4 million as a deduction. So in that case, your addition will be restricted up to the level of 4 million. That's the first point. And then second point, long-term investment in foreign entity can be claimed as a deduction, subject to certain condition. So here the condition that GAZT specifies, or in order to claim a deduction for long-term investment in foreign entity, the zakat payer in KSA has to prepare a zakat return or zakat computation for the foreign investment in the abroad entity and settle the zakat due as per the regulation, and then they are eligible to claim the long-term investment in foreign entities in your zakat base. Next point, properties under development for sales can be claimed as a deduction, and again it's certain condition. Those conditions that business to be very aware of before you claiming a deduction in your return. There are 4 conditions that has been listed in new regulation. This properties under development for sale can be deducted in your zakat base following these conditions. Number 1, this should be classified as a non-current in your fixed asset in your financial statement, and then intended for sale only once a development is completed, not offered for sale at its current status, and sales and advances received from the customer against this property should not exceed 25% of the financial value in the financial. So these are the 4 conditions that business needs to be aware of before claiming a deduction under this. And again, the next one is very interesting. This deduction was not given in the past Zakat regulation or in the past practice. The lease receivable can be deducted under a specific project called BOO or BOO. So these are all the specific project under lessor can able to claim a deduction on the lease receivable. This is only applicable for the specific project that GAZT has mentioned, and it has not applied for other leasing activities or other leasing projects. Other important points which was not there in the practice in the past Zakat regulation or past Zakat practices, the long-term loans has a maturity of more than 354 days, overlaps in 2 consecutive years, should be added to the Zakat base on a proportional basis. What does this mean? This means, for example, a business has obtained a loan in the month of 1st of July 2018, and they expect this long-term loan will be carrying over next year and expected to be completed in June 2019. So what happened in the past, we don't calculate Zakat for this 6 months, considering the fact that loan has obtained in the year 1st of June and it has not completed 1 full year. So what happened in the new Zakat regulation, it states even if you have obtained a long-term loan in middle of the year and you expect that loan carry forward to the next year, which completes 1 year, in that case, the portion of the loan that completes 1 year, in my example, July to December, 6 months, should be proportionately added to your Zakat base. And then this loans obtained from the bank, renewed or rescheduled with the same creditor or replaced by another source of loans to finance the same will not be interrupted, and it should be added to the Zakat base. When I say renewal or reschedule, for example, business, in most of the cases in our experience, we saw that companies obtain loan in 1st of every month and they obtain another loan to replace that loan. So in that case, the replace of loan with another loan will not be considered as a settlement, will be subject to Zakat. As per the new Zakat regulation, it will be considered as renewal of a loan. So business needs to be very awareful and careful on this point, because I have seen most of the clients have been having issues with this. So you can able to plan in such a way like you settle your amount within a year, not by obtaining a new loan under a separate contract. Yeah.
Just a couple of points on this. Firstly, with regards to the investment in foreign entities. So practically how you would get this deduction is that you would attach a computation of the Zakat payable on that foreign entity's investment. And that would be submitted along with your Zakat return for the local entity. Because simply the foreign entity cannot submit its own Zakat return on the GAZT portal. And the other thing with regards to the loans, as Dinesh pointed out previously, if there was a renewal or a rescheduling of loans, then that would interrupt the Hijriya, and Zakat payers may not have been subject to Zakat on those loans. However, now that would be not considered as an interruption, but a continuation, and therefore, if the loans would be more than 354 days in a year, they would, and if it were overlapping over 2 years, then Zakat would be payable in both years based on a proportion basis.
This is a very important topic that came in the new Zakat regulation, the statute of limitation. The statute of limitation, as we are aware, like it's there, always there in the tax law, but this is something new came up in the new Zakat law. So under the statute of limitation, GAZT can have a rise to issue an assessment within 5 years from a date of submission of the Zakat return. What does it mean? For example, if as per the current year, the 2014 year assessment has been closed, considering that it has already passed 5 years. So what does it mean? The GAZT cannot assess 2014? No, they can able to assess 2014, but where taxpayer has to object formally, and when it goes to the higher appeal committees or appeal committees, taxpayer have a strong point that GAZT has not followed the statute of limitation, and it will be in favor of a taxpayer. there is another important point that businesses should be very careful on this. So the statute of limitation can extend up to 5 years in case where the businesses fail to submit the zakat return, or in case where incomplete zakat return has been submitted, or the payment of the zakat was not settled within a statutory period, or incomplete amount has been calculated or reported. So this was not there in the past, but in the past businesses used to take advantage of this, and they used to file the returns after the statutory timeline. For example, for December year-ending client, 30th April is the due date, but businesses mostly used to file after the due date, since there is no specific regulation or GAZT has not been aggressive on this question. But with the introduction of this new zakat regulation, with this point, businesses needs to submit their zakat return within a due date, so that GAZT cannot extend the statute of limitation to 10 years.
Okay, we're going to spend a bit of time on this slide. This is the new assessment procedures, the new appeal procedures, which came into effect early this year and impacts all taxpayers, whether there's zakat, corporate tax, VAT, excise. So if you take an example that the business has received an assessment, if it decides to object, it has 60 days to file an objection. In order for the objection to be accepted, it needs to settle the tax on the accepted items. And also, it has to pay either an amount that ranges between 10 and 25% of the items not accepted, or provide a bank guarantee for up to 50% of that amount. The GAZT then has an option, the GAZT then is supposed to issue an amended assessment within a 90-day period. That's where we are, right? So if the business decides that it wants to appeal against these assessments, then it has two options. It can either approach the Internal Settlement Committee on a informal basis, or it can approach the GSTC, which is an administrative body that can then take the case up to the appellate committees. And just a quick note here that there are 6 parties to this procedure. So we have the business, we have the GAZT, we have the Internal Settlement Committee, we then have the formal procedures which are done by the GSTC, the General Secretariat of Tax Committees, followed by 2 appellate committees, the lower level being the Tax Violation and Dispute Resolution Committee, TVDRC, and then the higher appellate committee, which is the Tax Violation Dispute Appellate Committee. And now Dinesh will talk you through the process.
Okay, when company receive an amended assessment or have not received an assessment from the original date of filing the objection, that is 90 days, company has to escalate their assessment case. Either they can approach Internal Settlement Committee, or they can escalate the case in the GSTC portal for the new appeal committee, that is DVDRC. So in that case, business needs to be aware there is a timeline for each of this process, and bound to submit their response or objection within the timeline. If timeline get elapsed, then the zakat payer or taxpayer may lose their position or rights to object for the further hearings. So in order to register your case with GSTC, there are certain set of documents that the taxpayer or zakat payer needs to upload in the GSTC portal. GSTC is basically an admin body that connects between the GAZT, tax or zakat payer, and the new appeal committee. So once all the required documents are prescribed in the GSTC regulations, that needs to be uploaded in GSTC, along with the power of attorney whom you want to give this case to be handled by the tax advisor. So those documents needs to be uploaded in GSTC committee, and then GSTC committee will ask GAZT to share their response. Once GAZT response has been provided to the GSTC committee, GSTC committee will send the information to the tax and zakat payer in order to respond against the GAZT. In order to having both their response from GAZT and taxpayer, the case then be pushed to the new appeal committee, that is DVDRC. DVDRC will fix the hearing and meeting date with the client, and then the hearing will take place between the zakat payer or taxpayer along with the GAZT. And then the resolution will be passed in due date. Once the resolution has been passed, within 30 days, either zakat or taxpayer can able to accept the decision, or they want to go for the next appeal committee, that is DVDAC. That's the higher appeal committee. Once before filing an objection with the DVDAC, the tax and zakat payer needs to settle a full amount or submit a bank guarantee of full objected amount before proceeding your objection. At the end, whatever the decision that has been taken at DVDAC, that should be the final decision, and zakat or taxpayer cannot object further.
So just a couple of practical issues and certain benefits. I mean, firstly, we've gone through the slide with the assumption that the business has decided to appeal against the GAZT or the decision taken by the Internal Settlement Committee and wishes to take the case all the way to the appellate committees. The business obviously does have the option at any point of time to accept the position and settle the liability, and the case would be closed at that point. With regards to some of the advantages, I mean, what the role of the ISC, the Internal Settlement Committee, is basically to fast track the settlement of tax disputes. So the business can approach the settlement committee, you can have a meeting with them, and you could try and negotiate a settlement. And we know that in practice, this is proven to be very effective. In some cases, businesses have saved up to 50% of the assessed amount. So it can work. And secondly, it can save time and money for the businesses, because to proceed with the formal procedures via the GSTC and onto the appellate committees can be a very time-consuming task. We've covered this now. I think, Dinesh, is there anything on this slide that you would like to add?
Just businesses needs to be aware of the settlement that they need to make before filing an objection. In case where you file an objection without making the initial amount as explained by Raman in the previous slide, whatever the points that you accepted with GAZT, you need to settle upfront before filing an objection. And at the time of filing an objection, you need to settle 10 to 25% of your zakat liability under dispute amount, or you need to lodge a bank guarantee of 50% of the liability. So in case if you file to provide or settle this liability without after submitting an objection, then your objection will deem to be rejected because you have not followed the settlement process as per the new regulation. So business needs to keep aware of this.
Okay, we now come to some updates in corporate tax. So I'll briefly touch upon the amnesty measures because we've covered them in detail in our earlier seminar. So some of the measures announced were with regards to an extension to the filing deadline and the deferral of tax by up to 3 months, and in regards penalty waivers. So if you were due to file a tax return between the initiative period of the 18th of March to the 30th of June, that has now been extended by 3 months. So to give you an example, if you were a January year end, your due date to file the tax return would be the 30th of May, but now you have till the 30th of August to file the return and to settle the tax. On the penalty waivers front, there is no penalties if you decide to file a late return or amend previous filings before the 30th of June 2020. This is a good cash flow incentive to businesses to get their house in order, to ensure that the filings are up to date, because they could save potentially on a filing penalty of the higher of 20,000 or 25% of the unpaid tax whichever is the higher. And there's also a delay penalty of 1% for every 30 days in the settlement of the tax. There's also an exemption until the 30th of June if you were to register late, and you would not have to pay the penalty of 10,000. Okay, so some key amendments to the tax laws have been announced over the past few weeks, months. The first one is, in order to assess if a business is subject to tax or zakat, the GAZT now looks at ownership up 2 levels. So say, for instance, if you were a zakat payer, but you had, say, a GCC shareholder, and the one above was, say, a foreign shareholder, then potentially the GAZT may consider you as a corporate taxpayer, and you would be subject to corporate tax at 20% as opposed to the zakat of 2.5%. Interestingly, if you're a foreign company in Saudi Arabia and you've been paying tax at 20%, but you're owned by GCC shareholders, the GAZT have not given us any clarification. A question was asked if they would, in that scenario, look at 2 levels, and if the foreign company was owned by GCC shareholders, would it apply to would it be subject to zakat? But they have, as yet, we have not had a response from them. The next thing is the exemption from capital gain in case of a reorganization within a group. So say, for instance, if you have 2 capital companies within the same group, and there is a transfer of an asset, maybe a tangible asset or shares in case of a merger, potentially any gain that would have arisen is exempt, provided the asset remains within the same group for up to 2 years. The laws did not state whether the companies had to be within or outside of Saudi Arabia, but we have asked and received confirmation from the GAZT that they would apply the CGT exemption only if the companies, both the transferor and the transferee companies, are incorporated within Saudi Arabia. Shares of non-Saudi shareholders of a company that is investing in the Saudi stock market historically were subject to tax, however, will now be subject to zakat. And the last update, I think, is a very useful one and is probably aimed at encouraging foreign investment in Saudi. And that is that historically, there was a restriction on the capital losses that can be carried forward. They could only be carried forward if there was no change in ownership or control. However, under the new amendments, the losses now can be carried forward indefinitely, irrespective of the change in shareholding or control, so long as the business carries on the same activity. Okay, another key point, I mean, this is driven by what we've seen in the queries and the assessments from the GAZT. This comes up time and time and again. So let's go through these one by one. So the foreign purchase. So to give a very simple example, say a business reports 1 million Saudi Riyal in the tax return attributed to imports from abroad, but the custom bayan has got a different figure, either less than 1 million or more than 1 million. And there are reasons behind it. Namely, obviously you could have timing differences. You could have a situation where the bayan has all of the imports, not just the ones expensed to the profit loss account, but also assets. So the company may have actually capitalized those assets, and therefore there is a difference between the amounts reported in the P&L and what's showing on the bayan. You could also have scenarios where the imports were in the name of a related company, and utilized by the business, or the other way around, where the imports were in the name of the business but utilized by a related company. So there are a number of reasons why there can be differences, and the GAZT is well aware of these. So what they ask you to do is to provide a reconciliation of the differences, and so long as you're able to provide those, you should be fine. However, if you cannot satisfy the Gazette, then they do apply either a deemed profit, so that's effectively they tax the differences at a fixed rate, or they might disallow any differences. GOSI, which is the contributions settled on your employees, both Saudi and non-Saudi, also work similarly. So in January of every year, businesses are required to provide a list of their employees to the GOSI department. And on that basis, they settle the GOSI for that particular year. Again, the GOSI that's reported in the tax return may be different, either higher or lower. Generally, it's higher in our experience. But again, there are several reasons besides the obvious timing differences. The fact is that the GOSI is settled based on your employee register as of January every year, whereas you may have changes in your employees, people coming in, joining, leaving, and so on. And these sort of changes will only be reflected in the following year's GOSI records, but obviously would impact your tax return in the current year. And therefore, again, there are plausible and legal reasons why these differences happen. And therefore, the Gazette usually requests you to provide a reconciliation. And so long as they are provided, you should again be fine and there should be no consequences. Another point, the Gazette is always scrutinizing and looking at your related party transactions. As I'm sure most of you are aware, the withholding tax rate on payments to non-resident related parties are higher than if they were to non-resident third parties. And therefore, for that reason, the Gazette does request for a lot of information in order to compare the value of the services and payments that have been made, which are reported either in your annual withholding tax return or your monthly withholding tax filings, or the amounts that have been disclosed under the related party note in your tax return. So again, you need to be careful, you need to be prepared to provide this reconciliation, otherwise the Gazette is likely to impose withholding tax on any such differences. We then go on to the requirement to file a controlled transaction disclosure form and an affidavit and a CBCR notification. I will be covering this a little bit later on in the presentation, so I will swiftly move on to the last point, which is it's always been there. I mean, although you can file your return without the audited financials, when it comes to the issue of the Zakat certificate to you, you are required to file the Arabic financials in the Ministry of Commerce portal Kawam. The Gazette would verify that it has been uploaded before they would issue you with the Zakat certificate. Obviously, not such a concern this year because of the measures announced. The clients have already been receiving the Zakat certificates, but it's something which you do need to be aware of.
Just to add a couple of points to, in addition to the Raman information, it is always recommended that businesses should prepare this import purchase reconciliation at the time of submission of a tax return and keep it ready, or either to be attached as a supporting documents along with your tax return. Because once you submit your tax return, Gazette always import numbers are already linked with the Gazette system. So whatever the import purchase number that you're going to report in your tax or Zakat return, and they can have a view of a custom for the same amount, and they can see if there is any difference, they can issue an assessment directly. So in order to avoid such a query or assessment from the Gazette, businesses can use to prepare a reconciliation and submit along with the tax return. And same case applies for GOSI as
well. We've already gone through this in the Zakat section, so we wouldn't spend much time on it. The only thing couple of things that I would like to highlight is that if you're a taxpayer, then you're not required to settle any amounts that you wish to appeal against. You do obviously settle the tax on accepted amounts, but on any amounts you wish to appeal, the requirement to make the full payment arises only at the time of the hearing with the higher appellate committees. And I think we briefly touched upon the requirement for a power of attorney when you're uploading documents in the GSTC. Now, this is easier said than done. We've seen this in practice that there's a number of documentation requirements, namely the business has to provide its Saudi representative, who could be a consultant or an attorney, with the document. The document itself has to be tested by the KSA embassy, whether it's within Saudi or outside of Saudi. And then the representative needs to take the power of attorney and a letter of authority to the Ministry of Justice, which have their own procedures that need to be complied, and there might be requirements to obtain other documents from other ministries before a power of attorney is issued. So it's just a couple of things to be aware of. We now move on to the withholding tax updates, which will be taken through by Dinesh.
Yeah. As in the month of March, GAZT has provided initiative to support the Saudi businesses by extending the WHT tax VAT exercise deadline. In case of VAT, in case of withholding tax, where the original due date falls between the 18th March to 30th June, it will be extended by 3 months. As you can see in the screen, like for the month of March, April, May, the deadline for submission and payment has been extended by 3 months. So this can help business in managing their cash flow, where they can able to submit the withholding tax return in time, and they can extend and pay the payment till the extension period. And under GAZT amnesty, which also came in the month of March, where the businesses that have not filed or missed to file a withholding tax return or want to revise any withholding tax return, they can able to use this period under GAZT amnesty between 18th March to 30th June to correct or to amend any of your WTR without incurring any delay penalty. This is a very important step for the businesses to go back to their record or appoint or have a kind of health check on your transaction where you feel there is some sort of an aggressive position that the company has taken or wants to have a second opinion or detailed review. So this is a time to do that in order to not to incur any additional penalties, and you can also able to rectify your position in the withholding tax return in the past or whatever you want to amend. Yeah, this is the key update or treaty that came up in the beginning of the year. So this treaty with UAE is a significant benefit to most of the companies having transactions with UAE. Under the treaty, the important features were the PE. PE is a permanent establishment. The non-resident entity conducts a business or performs an activity in KSA for more than 183 days within a period of 12 months. They establish a PE in KSA. What happened if they establish a PE in KSA? So under business profit article in the treaty, the business profit article says that taxable rights is be given only to the country of residence where the non-resident belongs, unless they create a PE by doing business in another country for more than 183 days. Once PE has been created, the profit attributable to that PE will get taxed in KSA or any other country where they establish the activity. So business needs to be very careful and aware of this PE measures and PE thing before claiming treaty benefits. Another important thing that have came up in the tax treaty with UAE is there is no exemption for capital gains realized in the other treaty country. Means like UAE entity having a shares in KSA unlisted companies will have to pay their capital gain. There is no exemption for that. As you can see in the table, these are all the important services where you can get a benefit in terms of applying for the treaty. As per the royalty, as per the domestic law, the withholding rate is 15%. When you want to apply for a treaty, it can be reduced to 10%. As per the dividend, it applies same domestic and under treaty, it's the same percentage. In terms of support services, where in a domestic law, it applies 5 to 20%. Where under article business profit, the businesses can able to apply treaty benefit and can get exempted at 0%. Interest is also same, where as per the domestic law, it's 5%, and by applying a treaty, business can get 0% or exempted. Yeah, it is important for the businesses to understand the types of PE and the risk involved in the PE. As per the domestic law, the KSA law, the PE of a non-resident get established from the first day of the business activity that they perform in KSA. There is no timeline has been mentioned in domestic law. So as per the GAZT, they say the PE has been established from the day one. And in terms of virtual PE, where the service contract, the interpretation of GAZT is it does not require the physical presence in KSA. Irrespective whether the service happened outside KSA or inside KSA, it deemed to create PE if it extends for more than 183 days. So business needs to be very careful where they have a service contract and they wanted to apply a treaty benefit. They need to look into this point and make sure like there is no PE has been established before you apply for your treaty benefits. And as I said in the service contract, the duration of service extends more than 183 days in a year may trigger a PE. And then the businesses have a distribution agency agreement or contract manufacturing agreement with local over here that may trigger a PE as per the updates. And some of the important WST risks that I'm going to cover, and I'm going to it is settled off or settlements happen through accounting adjustments or netting of the receivable and payable balances between the related party. This netting off through accounting adjustments or set off may create a withholding exposure, and it will be termed as a payment, and that should be subject to withholding. Businesses can look into these scenarios in the past. If they have identified such issue, it is the best time to correct their mistake by filing the WTF for those transactions without incurring any delay penalties under GAZT amnesty. And other common issues that we have noticed with the businesses is where the invoice as the total amount, for example, in case of design services provided by the non-resident or any advertisement services provided by the non-resident, which includes the cost of material. And if there is no breakup has been given in the invoices, how much of the amount pertains to the services and how much of the amount pertains to the materials, in that case, the entire amount will be subject to WHT. So this is the thing business needs to be careful with the non-resident, with an agreement with them to break the cost for the services separately and materials or any other things which does not apply withholding tax should be broken separately. Other example I can give you, like some of the non-resident companies sends employees to perform some sort of engineering services or technical services in KSA. And whatever the reimbursement cost incurred by those non-resident in terms of the meals, accommodation, taxi, and other miscellaneous expenses charged in the invoice to the KSA company. This is where the KSA company should ask the non-resident to have a supporting document for those investment, so those expenses. So without having the supporting document, so GAZT may take a position and subject the entire amount to WHT. So it is important for the businesses to have those reimbursement supporting documents in the file in order to avoid, in order to not to have withholding tax on those amounts. Yeah, as we are talking about the treaty, as per the GAZT, there are two approaches that's been currently followed by the GAZT. One is a refund approach, another one is exemption approach. In terms of refund approach, the taxpayer settles the WHT as per the domestic law, and after gathering all the treaty documents, when I say treaty documents, there are three main documents that needs to be attached or submitted with GAZT. First document is K7A. that is the tax treaty form that's been prescribed by the GAZT, where the businesses should be disclosing the non-resident vendor amount claimed as a treaty separately. And then K7B, that is a tax residency certificate from the non-resident. And then K7C, that is undertaking form, should be printed on a KSA company letterhead, saying that if there is any false representation in the above statement, then we bear the responsibility of withholding tax and delay penalty. So these are the documents that needs to be attached with those approaches. And in terms of exemption approaches, where businesses used to settle the gross amount to the non-resident party and claim the treaty benefit at source by attaching all the documents that's prescribed with a submission of WHT. The risk in the exemption approach is that in the future, if GAZT identified and rejects the treaty application, then the KSA company should bear the WHT liability along with 1% delay penalty for every 30 days. So that's the risk in the exemption approach. But we have commonly seen businesses are adopting exemption approach. And then other challenges that faced during the claiming a treaty is there may be delay in processing the treaty relief, especially in case of refund approach, where GAZT takes, in our experience, you can say like 6 months, 1 year to process the application because of the interpretation of PE by GAZT in terms of service contract. And also the other challenges that businesses are commonly facing in terms of beneficial owner condition as not made for the payment, made for the royalties and the interest. When I say beneficial ownership is a person or the entity who has a right to use and enjoy the income. So that condition has to be met before applying a treaty.
Okay, we move on to the final section of our presentation, some transfer pricing updates. Firstly, I would like to remove the misconception amongst many people that transfer pricing is a tax. It isn't. It basically sets the standard whereby transactions with related parties must be undertaken on an arm's length basis. So in Saudi Arabia, there are a number of requirements that need to be complied with. So in terms of the controlled transaction disclosure form and the affidavit, they're required to be filed at the time of filing your tax return. They apply they apply to 100% foreign shareholders or mixed companies. So 100% Zakat entities are exempt, rather are not required to file these disclosure forms. Then the other requirements is for businesses in Saudi Arabia need to maintain a master file. That is normally prepared at group level, and it's a group snapshot of the operations of the group in terms of the structure, the ownership, where it conducts its business, the type of related party transactions it has, the presence, where are the intangible assets maintained, where are the assets, where are the employees. Basically, where does the jurisdiction have, where does the M&E have an economic substance? In Saudi Arabia, in addition to that, you also have a requirement to maintain a local file, which is a requirement. It is basically a snapshot of the local business. So pretty much similar to master file, but with relevance to the activities undertaken in Saudi Arabia. And again, these do not apply to 100% Zakat-owned companies. And there's also de minimis, that in order, only if the value of your related party transactions are more than 6 million riyal, you're required to maintain these documents. These documents are not required to be submitted to the GAZT. However, if there is a TP audit, they may request for it, and you have 30 days to provide that information. And then for very large businesses that have turnover in excess of 3.2 billion or Zakat headquartered companies, there is the requirement to file a country-by-country report, and you're required to notify this requirement. You're required to notify this at the time of filing your tax return, and you're supposed to provide information with regards to the nature of the business, the ownership structure, as well as who will be filing the CPCR report if it is being prepared outside of Saudi Arabia. So yeah, some of the lessons we've learned in terms of TP audits that have been conducted, and certain red flags and measures that you can implement to reduce the risk of a TP audit or the impact of it. So the first thing is the requirement is to update the local files annually. This should not be a cumbersome exercise, provided there is no major restructuring. You're basically required to update the numbers in your related party transactions, and everything else would practically be the same. Master file, we've had the clarification from the GAZT. They did not expect us to update that every year, which is good news, and which is international practice is normally 3 years, unless, of course, the M&E has restructured, in which case you are then required to prepare a new master file. You must also maintain all intercompany agreements, which sets out the basis of the price that's been charged in your related party transactions. You need to have a detailed function analysis in terms of who is taking on the responsibilities, who's employing the assets, and where is the economic substance just to justify the price that's being charged. You also have to do a bit of benchmarking, or a comparable analysis with other businesses that operate in your industry or sector. Just one point here that we've seen in the past that some taxpayers have used loss-making companies as a comparison, and that the GAZT have confirmed is incorrect. So you cannot use loss-making companies for the purposes of doing your benchmarking exercise. Obviously, the local file needs to be consistent with the information that's been provided in the master file and any group TP policy document that's maintained by the M&E. If you realize that you've made a mistake in the price valuation, you can take a proactive approach and amend your returns, and that would risk any associated penalties or any shortcomings which the GAZT may find if they undertake an audit in the future. And finally, you also, if you are large enough to prepare a country-by-country report, a greater interaction will be required within the companies in various jurisdictions, because the template is such that you're required to provide information on a country-by-country basis with regards to the revenue, the assets, the employees, and the profit margins, and the tax paid, and so on. In terms of the high-risk companies or businesses that would are at risk of a TP audit, if the business in Saudi Arabia is consistently making a loss or operating on low margins, or where there is significant amount of transaction-related parties, or say if all the revenue is generated from a related party, then that would be a red flag. And finally, also, if there is a restructuring exercise being done, then you could be picked out on a TP audit. And this is the final slide, just very briefly on a couple of recent updates. As you may already be aware, that Saudi Arabia has signed and is part of the BEPS action plan. So the action plan has 15 main actions, of which 4 are minimum, and all signatories are obliged to comply. So there's 2 here that Saudi has recently implemented. One is Action 5, harmful tax practices. And this is simply a situation where there's an exchange of information between Saudi Arabia and a number of foreign tax authorities. My last count was nearly 130 countries. So it's basically an exchange of information about what is the non-resident doing in Saudi Arabia in terms of his business, how much tax he's paying, is he making losses, is he subject to an assessment, any procedures, any enforcement procedures or any prosecution. This sort of information Saudi Arabia is obliged to provide the foreign country, and vice versa. And the other one regarding Action 15 is a multilateral instrument, and this is meant to target anti-treaty measures. So basically, it's to prevent the businesses from adopting a sort of a treaty shopping exercise. So whereby your supplies are based in a country where there is a favorable treaty exemptions. There are currently 15 treaties that are currently in force, but that will increase as Saudi Arabia has basically implemented multilateral instruments in regards to all of its double tax treaties, which I believe is about 53 or 55 on my last count. Okay. So that's the end to our presentation. I see there's been a number of questions asked, which is great. Mubin, Adil, would you like to maybe go through some of them? For the benefit?
So look, we've got only a few minutes left. I mean, we've had a lot of questions. We've answered all of them. But, you know, I thought I'd go through a couple of them. I mean, this one keeps coming up from time to time. A lot of clients still keep asking whether they need to maintain their books and records in Arabic, and the answer is yes, you do need to do that. Although some GAZT officers sometimes during an audit or an assessment, they tend to be a little bit more flexible, but the requirements are that you do need to make them in Arabic. One of the other questions was that, you know, clients asked, we're in the business of leasing. Can we claim a deduction for our lease receivable? They are long-term assets which are in the bank's name. I think Raman or Dinesh, you want to answer that?
Yeah, as I mentioned in my earlier slide, under the leasing receivable, as per the new Zakat regulation, there your lease receivable under the project of boat under this project, you can able to claim your lease receivable.
Okay. Another question is in relation to foreign purchase reconciliations. There are variances in customs records, and we have had multiple follow-ups with customs authorities for correction, but it is still pending. How will GAZT react to such variances? Is it the company to be the bearer of the cost of such errors for customs records? I think, look, what you need to do is submit a reconciliation for the difference, along with the evidence that the custom records are incorrect, and chase it up with GAZT. That's what we would be recommending that you do. I think, look, all the questions have been answered. We'll make them available to people. We'll make the slides available as well as the recording. So we'll end the presentation there. And thank you for everyone for joining us today. Eid Mubarak in advance. And I hope to see you all soon. Thank you very much.
Thank you.
Thank you for joining.